Hello class, and welcome to the video lecture for Corporations and Bonds Payable. Learning Unit 2 covers bond amortization. Two methods are used, the straight line method and the interest method. You've already learned about the contract rate. The contract rate is the rate printed on the bond certificate. But interest rates change daily. At any given time, a bond can be purchased or sold at a rate other than what's printed on the certificate. This is called the market rate. We also have what's called an effective rate. The effective rate is the real interest rate of the bond. First, let's look at a discount. For example, we have Ch20LU2 Corporation, which has bonds to sell. These bonds have a contract rate of 12%. The going rate in the market is 13.2%. This means potential buyers of the bonds want 13.2% interest, not 12%. If Ch20LU2 Corporation lowers the price of the bonds, offering a discount, potential buyers might be more likely to purchase the bonds with a 12% rate because with the discount, the bonds will effectively give a 13.2% interest payment. The difference between the bond price printed on the bond certificate, $1,000, and the price it actually sells the bonds for, $910, is called a bond discount. The same thing can happen if the contract rate is actually higher than the market rate. In that case, the corporation can sell the bonds for more than the face value. The difference between the face value and the sale price is called a premium. Bond discounts and bond premiums are recorded in special general ledger accounts. The carrying value is the face value of the bond minus bond discount or plus bond premium. Carrying value is just like book value. Remember, we had book value when we accounted for assets and depreciation. The book value of a long-term asset is the cost of the asset minus accumulated depreciation. This is similar in that the carrying value of a bond is the cost of the bond minus bond discount. With bonds, we can also have a premium, and a bond premium is added to the cost of a bond to arrive at carrying value. Amortization is the process of writing off the premium or discount over time. Here's an example. On January 1st, Ronson Corporation issued 200 12% $1,000 10-year bonds at 97. At 97 means the company issued the bonds for 97% of their face value. If the face value of one bond is 1,000, 97% of 1,000 is 970. This results in a discount of $30 per bond. We record the issuance of these bonds with a debit to cash for the amount of the cash received, which is 200 bonds times the price per bond of 970, for a total of $194,000. Next, we record the discount on bonds payable. Discount on bonds payable is a contra liability account with a normal debit balance, and the amount, in this case, is the $30 discount times the number of bonds issued, which works out to be 6,000. Finally, we record the bond liability itself with a credit. The bond liability is for the face value of the bonds because regardless of what the bonds are sold for, the face value of the bonds is paid to the bondholder on the maturity date. Let's look at how this information is presented on the balance sheet. Bonds payable is listed in the long-term liability section. The contra account, discount on bonds payable, is listed right underneath. We draw a line under the discount to indicate a subtotal, and to the right of the line we have the carrying value, which is $194,000. Over time we will amortize the bond discount, which means we will write it off to bond interest expense. This will slowly decrease the amount in the discount on bonds payable account. By the time we get to the maturity date, the balance in the discount on bonds payable account will be zero, and the carrying value of the bonds will be the full face value of $200,000. Now let's look at the amortization process. In this example, the discount on bonds payable is being amortized using the straight line method. That means that on each interest date, the same amount of the bond discount is amortized. Remember that these were 10-year bonds and interest is paid semi-annually. That means we have 20 interest payments and 20 interest we have 20 interest periods and 20 interest payments. If we want to amortize the discount over these 20 periods, we take the total amount of the discount, which was $6,000, and divide it by 20. That means we amortize $300 each time we pay interest. Amortization of bond discount increases interest expense. We have our regular interest expense due to the payment of interest, which is the face value of the bonds, times the contract interest rate, times time, which is $200,000, times 12%, times 6/12. That works out to be $12,000. We increase the interest expense by the amount of the amortization, so we have a debit to interest expense of $12,300. We record a decrease in discount on bonds payable with a credit. Remember, the account discount on bonds payable has a normal debit balance, so a decrease means we must credit the account. Finally, we record the cash payment to bondholders, which is the amount of interest we calculated of $12,000. This table is called an amortization schedule. It's a way to keep track of the amounts we need to journalize every 6 months. The periods in the first column refer to interest periods. Remember, we determined we have 20 total. Next, we have the carrying value at the beginning of the period. It's slowly increasing due to the amortization of the bond discount. Next, we have total interest expense. Notice that this is the same amount every time. That's due to using straight line amortization. Next, we have the interest paid to bondholders. This refers to the amount of cash being paid to bondholders. It's important to not confuse interest expense and interest payment. The interest payment is based on what the bond certificate says it will pay. What we just covered is the straight line method of amortization. The bond discount is divided up equally among interest periods and is written off to interest expense each time interest is recorded. When using the straight line method, the interest expense, the interest paid, and the amount of discount or premium amortized is the same each time. Now let's look at what happens when interest payments aren't due on December 31st. In this example, let's assume the interest payments are on April 1st and October 1st. At the end of the year, when financial statements are prepared, we need to accrue any interest expense incurred in order to make sure all appropriate expenses are on the income statement. In the last example, we determined that the amount of interest paid every 6 months is $12,000. If a 6-month interest cycle starts on October 1st, how many months of interest expense do we record as having been incurred on December 31st? Well, that would be 3 months worth: October, November, and December. We also determined we amortize $300 of bond discount every 6 months. So how much do we amortize on December 31st if the interest cycle starts on October 1st? Again, that would be 3 months worth, which is $150. The adjusting entry we record on December 31st is to accrue 3 months worth of interest and amortization, so we debit interest expense for $6,150. We only reduce the discount on bonds payable account by 3 months worth, so the credit is $150. The final part of the entry is to record the amount of interest payable to the bondholders, which is 3 months worth, or $6,000. Remember that December 31st is not the day the bondholders are paid interest, which is why we record it as a liability and not cash. Now let's look at the situation of a premium. In this example, Ronson Corporation is issuing, on January 1st, 200 12% $1,000 bonds at 102. At 102 means the bonds are being sold for 102% of their face value. The current market rate is 11.8%. So first we record the sale of the bonds. The cash received is the face value of the bonds times 102%, so that's 200 times 1,000 times 102%, which is $204,000. The face value of the bonds is $200,000, so that's the amount of the credit to bonds payable. The difference is the premium. The $4,000 difference is recorded in the account Premium on Bonds Payable, which has a normal credit balance. Here we have the balance sheet presentation on the balances in the accounts we used in the last journal entry. Again, we have bonds payable in the long-term liability section of the balance sheet. Listed directly underneath, we have premium on bonds payable. In this case, the premium is added. Premium on bonds payable is called an adjunct liability account. To the far right is that very important number of $204,000, which is called the carrying value of the bond. Now we're going to amortize the premium, which will reduce the premium on bonds payable account over time to zero. And eventually the face value of the bonds will equal the carrying value. Here's the journal entry for the first interest payment on June 30th. Our total premium was $4,000, and since we have 20 interest periods, we amortize $200 each interest period. We reduce the premium on bonds payable account with a debit. The amount of interest paid to the bondholders doesn't change. It's always what's printed on the bond certificates, which in this case was 12%, and 12% of $200,000 is $12,000. We record interest expense as a debit, but in this case, we subtract the amount of premium amortized. Shown here is the amortization schedule for a premium. We begin with the carrying value on the left of $204,000. Total interest expense is equal to the interest paid minus the amount of amortization. And since we're using straight line amortization, this amount doesn't change from year to year. The amount of interest paid to bondholders is the same every year as well. Notice how the carrying value gets lower and lower every year until the very end. After 20 interest periods, it's $200,000. I'd like to do exercise 20B-3 on page 734. It says Divine Corporation issued $340,000 of 6% 20-year bonds at 93 on March 1st. Semi-annual interest is payable on March 1st and September 1st. Amortization is by the straight line method. Okay, number 1 says record the issuance of the bonds. So to record the issuance of the bonds, we need to figure out the amount of cash received. Now the cash received is the amount of the bonds that are issued, $340,000, times the percentage of the discount, just 93%. So that equals $316,200. Okay, we also need to know the face value. And what's the face value? It's $340,000. It's given in the problem. And we also need to know, the last thing we need to know is the discount. The discount is the difference between the two. So if we received, the face value is $340,000, and we subtract the amount that we receive, $316,200, excuse me. So we can determine that the discount is $23,800. Okay, so let's journalize this. We're receiving cash, so that's a debit, and the amount of cash is $316,200. Next, we record the discount on bonds payable. Now, is that a debit or a credit? It's a debit. Because to increase a discount on bonds payable, because discount on bonds payable has a normal debit balance, we debit it. So I'm just going to abbreviate it, discount on BP of $23,800. And finally, we record the liability, which is bonds payable. Having some troubles with my pen here. Bonds payable. So that's the face value of $340,000. So at this point, no interest has been incurred. We're just recording the issuance of the bond. Number 2 says record semi-annual interest payment on September 1st. Okay, so how much is that interest payment? Let me make a little room here. The interest payment is equal to the face value of the bonds, $340,000, times the rate. Now, what's the rate? They tell us the rate is 6%. Now, this is the stated rate on the bonds, 6%, times the time in terms of a year, and the time is 6/12 because we're working with 6 months. And that equals $10,200. Okay, now how much of that discount do we amortize? Discount amortization using the straight line method means we start with the total discount, but we need to divide it by the number of interest payment periods. And how many interest payment periods do we have? Well, these are 20-year bonds, and we pay interest twice a year. So that means we have 40 interest payments. So we need to amortize the discount 40 times over 20 years. So let's divide that by 40, and we get 595. Okay, and now we have interest expense. Interest expense is equal to the amount of interest that we're paying the bondholders, $10,200. We get that from right here. Now, do we add or subtract the discount amortization? We add it. When you have a discount, you add it. So we're going to add these two together to get the total amount of interest expense. So that equals $10,795. Okay, so let's journalize this. Make a little room up here. This is number 2. So we debit interest expense for $10,795. Now, do we debit or credit discount amortization? Remember, when we increased it, we debited. So now we're decreasing. We slowly decrease over time by $595 every time we record interest. So we decrease it with a credit. And finally, we're going to record the payment of interest to bondholders. The interest that we're paying is $10,200. So that's done with a credit. Okay, so number 3, retirement of bonds at maturity. At maturity, what's the balance in the bonds payable account? Well, bonds payable, we recorded at issuance, was $340,000. It doesn't change. It doesn't change until we retire the bonds. So when we retire the bonds, we take the bond payable, we zero out the bond payable account, and we do that with a debit. $340,000. Okay. And so what's the credit portion of this? Well, it's cash, because when we retire bonds, we're paying off all of the bondholders. So now our bond payable account is zero, and we've paid it off. Now I'd like to add a couple things to this problem. Let's say it's December 31st in the first year, and it's time to record adjusting entries. The last time you recorded interest expense was September 1st. So between September 1st and December 31st, 4 months have passed. So interest has accrued, and we have to record it. If the amounts we recorded earlier were for a full 6-month period, we want to accrue 4/6 of those amounts. So the interest payment we had calculated the 6-month amount was $10,200. But if we only need 4 months worth, we multiply that by 4/6 to arrive at $6,800. Now the discount on bonds amortization we had calculated was $595 for 6 months, but since we only need 4 months, we can multiply it by 4/6 to arrive at $396.67. Okay, so our interest expense we had calculated earlier was $10,795, but since we only needed 4 months, we multiply it by 4/6 to arrive at $7,196.67. Okay, so let's record an adjusting entry for December 31st. I know this isn't part of the problem, but I want to use it as an example. So we record a debit to interest expense. Which is right here. So I'm going to go ahead and round that to the nearest dollar. 7,197. And then we record the discount on bond payable amortization. Now is that a debit or a credit? It's a credit because we're reducing it. And I'm going to round that to 397. Okay, and then we have our interest payment that we calculated, which would be $6,800. But are we going to credit cash? No. The interest isn't paid until March 1st of the next year. So until then, we just have a liability. And so I'm going to record this as interest payable for $6,800. Okay, so now let's do the journal entry for March of the next year when the interest payment is made. we already recorded 4/6 of the interest expense with the adjusting entry. So interest expense on March 1st is only for 2 months, or 2/6 of the total amount. So that's also the same with the amortization of the discount on bonds payable. So our discount would be equal to 595. This is for March 1st. Okay. Times 2 months out of 6 months. And that's $198.33. Okay, and then our interest expense is $10,795 times 2/6, which is $3,598.33. So we also have to reduce the liability, this one right here, that we recorded in the adjusting entry to 0, since we're paying the bondholders now. So we're going to be debiting bond interest payable. I'm going to make a little bit of room here up at the top to make this journal entry. Okay, so the March 1st journal entry. We have interest expense. Oops. Sorry about that. Interest expense for 2 months. That's right here, 2 months. 3,598. I'm just going to round that. And then we have bond interest payable. This interest payable right here. So we're actually paying the bondholders now. So we're going to reduce this liability with a debit. So we've just made the liability 0, which is good because we're actually going to pay now. And then we also need to record 2 months worth of the discount on bonds payable amortization, which is done with a credit, and we calculated that as $198. And finally, we're going to record the decrease in cash because we are paying the bondholders. And how much are we paying them? The full amount, $10,200. Okay, so do total debits equal total credits? Well, if you have $35.98 plus $6,800, that's going to equal $10,398. And if you have $198 plus $10,200, that also equals $10,398. So our total debits equal total credits. Alright, so that wraps up Learning Unit 2. In the next Learning Unit, we'll cover amortization using the interest method.